Good afternoon, good morning, everyone. As get settled in, we will start in just a minute. This is the NFA webinar on the FHA final rule. So just get settled in and we'll start in just a minute. Great to see you, Patrick, Heather, and Sarah. Looking great as always. Thanks for joining.
Good to be here. Welcome to everybody.
I was told this morning that this is my webinar shirt, which I didn't know I had a webinar shirt. So next time you see me in a webinar, you will not see me wearing this shirt. I thought I mixed it up a little bit better than that. All right, we'll give it another 30, 45 seconds. It's just 1 o'clock right now, Central Time. So Patrick, I'm still used to seeing you in your office at home. I got so used to that background.
Yeah, I'll be there Friday for the industry flood call. But yeah, this is the real office background here.
All right. Patrick, Heather, Sarah, y'all ready? Shall we get started?
Yeah.
Great. Well, thanks everyone for joining, making time as we all ramp up for the holidays. We thank the NFA team for supporting getting this webinar up and running in short order. As we all know, the HUD just recently issued this final rule and it becomes effective next week. So we thought, and the board agreed, that it was worthwhile to you, the members, for us to hold this member-only webinar. So we appreciate you participating. So you could advance to the next. So let me introduce the panelists here that are joining me today. So we have Sarah Singhouse. Sarah is the Director of Strategic and Industry Engagement at the Mortgage Bankers Association, where she develops and manages residential servicing initiatives, including MBA's Servicing Executive Council. Sarah oversees MBA's policy work related to flood insurance and natural disaster recovery and is a frequent speaker on industry issues. Sarah received her Juris Doctorate from the University of New Mexico. Is that the Lobos? Is that
the Lobos?
Lobos, all right. Heather Wright. Heather is a partner at the Bradley Law Firm. Heather helps a broad variety of commercial clients identify operational risk and determine business solutions to mitigate those risks, with a particular focus on advising clients about risk management through insurance. Heather helps policyholders maximize insurance recovery under a variety of commercial insurance policies. Heather also provides regulatory and compliance advice to lenders regarding compliance with and alleged violations of security agreements and other contracts in matters involving property insurance and flood insurance. Welcome, Heather. And then Patrick. Patrick currently serves as on the NFA Board of Directors and is the Vice President of Industry Relations and Compliance for Global Housing Homeowners Business within Assurant. Assurant is the mortgage industry's leading provider of lender-placed insurance and related outsourcing services and a leader in the NFIP's WIO business. Patrick and team are responsible for regulatory change management, responding to new legislation and rulemaking that occurs at a federal, state, or investor GSE level. This includes compliance with federal flood regulations and agency rules, GSE guides, and state insurance regulations. So welcome to all of you. So we're going to spend the next hour kind of walking through, as you see outlined here on the agenda slide, a couple of housekeeping items, if you don't mind. Okay. Showing those housekeeping items. If you click through one more. There. So a couple of housekeeping items. For one, all the audience is muted, but you do have the opportunity through chat to submit questions. This session is being recorded. And most importantly, nothing you hear today is to be considered as legal advice. It is not. This is our personal opinions and the personal opinions of the panelists. And so it does not necessarily reflect the opinions of their employers or of the National Flood Association. So with that, before we get into the slides and just run across the panel real quick, Sarah, I know the NBA has issued a statement about this release by HUD, and I think we can all agree that this is an important step. We are talking about an estimated 20% of the single-family mortgage market with FHA lending. So do we all agree, and I just go down the line with Sarah first perhaps, do we all agree this is a positive, significant first step and this is helpful to these FHA borrowers in terms of consumer choice?
Yeah, I do think it's a helpful first step. It opens the door to allow some private flood insurance. We'll see if it opens the door as wide as we would like it to be opened, yep. But yes, it's a good step.
Patrick and Heather, go ahead.
Go ahead, Patrick.
Yeah, I would agree. I think it's a great first step. And when you look at that 20% that FHA programs really tend to support first-time home buyers and low mod. And that's a really important demographic in terms of kicking off the housing cycle, getting folks in homes, and then they move up and where they renovate, et cetera. And so it's an important demographic that's being served here in terms of broader access to flood insurance.
And I will throw in, just because a lot of my work is on the lender side, the benefit, especially to regulated lenders, for having this rule, in that some of them were, or all of them, if they wanted to originate FHA loans, they were stuck between having a mandatory acceptance of a private flood policy on their regulator side, but then not being able to accept a private flood policy on an FHA loan. And so it created some trouble for a lot of the regulated lenders who have been mandated to accept private flood since 2019. So.
Great. It sounds like we all agree. Positive first step. Now let's talk about what else there is to say about this. So you can go to the next slide, please. So Sarah, I'm going to turn to you first. I know the NBA has worked diligently for your members over several years on the issue of private flood acceptance for FHA insured loans. Can you take a few minutes to give some background to the audience, how we got here with respect to FHA insured loans and private flood acceptance?
Yeah, absolutely. So once upon a time, when Congress actually was getting things done, the Bigger Waters Act was passed. This was in 2012. And it mandated that certain federal lenders, federal agencies, accept private flood insurance in lieu of an NFIP policy in satisfaction of the mandatory purchase requirement. And then in 2019, the joint agencies issued their final private flood insurance regulations and outlined what was required, the definition of private flood insurance, compliance aid language, gave lenders some flexibility in terms of being able to accept policies that may not meet the definition. They had the ability to, it was discretionary acceptance of the policies that the regulations provided for. And even before those 2019 regulations were finalized, we started reaching out to FHA because we had heard that there were situations where an FHA loan failed to close because of the difference in premium between a private policy and an NFIP policy, and the lender being unable to accept the private policy. We heard in some situations that the difference was as much as almost $1,000 in premium. So we reached out starting in 2017 with fellow industry stakeholders, insurance groups, realtors, requesting FHA take a look at the language in their regulation and their policy. Unlike the GSEs and unlike USDA and the VA, FHA specifically referenced NFIP policy being required and did not mention at all allowing for any other type of insurance. So starting way back in 2017, we started pushing them, urging them to change their the language in their regulation. And finally, not too long ago, I guess, or a couple of years ago, they finally issued a proposed rule, which is substantially similar, at least the final rule is substantially similar to what they proposed. But it was a long battle, about 5 years trying to get this change. So we're definitely happy to see it. But as my other panelists will go into further, I think there's some key differences between the FHA program, private flood insurance requirements, and the federal.
Yeah. So, yeah, thank you. And Caitlin, do you mind advancing one slide and then the next slide? Let's go to the next slide. So you mentioned, Sarah, the proposed rule. And I think this, some of this information is kind of what you spoke to.
Yep.
And then there in between the proposed rule and the final rule that Heather will walk us through, there was this period of industry consideration and response. And Caitlin, do you mind going one more slide forward?
Yeah.
Sarah, how industry responded, including the MBA, to that proposed rule?
Yeah, absolutely. So when the proposed rule was released, we got together with 8 other organizations, MBA and the insurance trades, realtors were there, ABA, a broad coalition, and we analyzed the rule, the proposed rule, and we wrote a joint comment letter, which I thought was very strong given the number of trade associations representing sort of all the full cycle of insurance in the residential lending environment. And there are a few key items that we recommended. One of the most important, I think, was conforming their compliance aid language to the language that was already in place in the federal statute and the federal regulations, and basically have that alignment across the board, because the industry, by the time FHA's rule becomes effective in a few weeks, next week, the industry has been working with private flood policies under the federal regulations for several years now, and insurance companies have as well. So the more that we can have FHA align, the easier it is for everyone. We encouraged FHA to add discretionary acceptance to allow lenders to accept a policy that may not meet FHA's strict criteria for private flood insurance, may have some slightly different, a deductible may be slightly different, or something that the lender still felt that it was a good policy in terms of safety and soundness. It still met the other criteria. And we definitely, again, wanted the alignment in how they define private flood insurance, because again, the industry has been working for several years, and our insurance partners have as well. So the more alignment and more consistent that FHA's regulation could be and their policy, that was what we urged FHA to do.
Yeah, and I agree. I think alignment seemed to be the theme there, Sarah, and I think that is what that's what HUD talked about wanting to do. So that did seem to make sense. I agree. It was a strong response. If you could advance the slide. I just wanted to highlight also that the NFA sent an additional letter, and I want to thank Karen Fresh, who may be on today from Tokyo Marine Highlands. She led this effort for NFA to specifically weigh in to lend our support to what the joint trades had done, but to put our particular interest and insights into that comment letter as well. And last thing, Sarah, and then I'll go to Heather. But last thing, Sarah, as you think about all the effort that went into it, I know you've probably been involved in hundreds of comment letters across many federal regulations. How important is it that the NFA is part of that effort and as part of future efforts to submit comment letters?
Well, I think it's critical in terms of adding to the credibility of the comments that are made, and the fact that NFA's membership is it pulls also from different stakeholders and different participants in the industry. It lends credence to the arguments that we make in response to proposed rules and regulations, but it also adds, through the NFA, we can get data, we can get specific examples that maybe lenders can't access or don't have, privy to that kind of information. For example, on the what's coming to mind, premium information or things like that. But having the broad coalition and having NFA, I think adds a lot of credibility in our comment letters, for sure.
Thank you. Next slide, please. And turning, Heather, now to you. So now we have the final rule that's it's been issued after the industry response that Sarah talked about. So hopefully you have some good news for us here. Keeping it positive, perhaps. Can you take a few minutes and walk us through the final rule and the regulations as that will be implemented effective December 21?
Definitely. So despite our best efforts across multiple trade groups within the industry, the FHA did not accept a lot of our proposals, and they made a couple of tweaks, but none of them really necessarily worth us covering today. They weren't the big, what I would call the big ticket items that a lot of us focused on, which was really uniformity across the industry. But I do encourage folks who are in the FHA world and who are also regulated by the prudential regulators to read through the Federal Register publication of the rule, because the first 7 or 8 pages go through what all of the comments were, how HUD is responding to them, that they considered them, goes into a lot of detail about what the comments were. And I always think that can help folks in understanding kind of why the rule is the way it is, or at least why HUD thought that it was necessary to have it the way it is. So it's good to read those, because I think more information can help people understand, especially from a compliance standpoint, what they're trying to do. If we could get the next slide, please. So summary of the final rule is in the regs, what they did is, as Sarah had mentioned, it was previously required that flood insurance had to be purchased on FHA insured loans if a property was in a special flood hazard area, and it specifically, instead of just referring to the mandatory purchase of flood insurance, specifically referred to the mandatory purchase of flood insurance through the National Flood Insurance Program. So it took several years to get them to add in a few words that are basically, or private flood insurance. And then the rest of the regulations kind of walk through exactly what private flood insurance is, how it is can be accepted on FHA loans. One of the things, the critical differences between the prudential regulator rules and the FHA rule is there is no mandatory acceptance under the FHA rule. When the prudential regulator rules came out, and we all started looking at them, there's mandatory acceptance, discretionary acceptance, the compliance aid, and then mutual aid society. And so if you think about those kind of four big categories, the FHA rule is different on all of them. So when you look at it from that standpoint, it can be very helpful to understand exactly how different this rule can be, even though when you look at it first glance, it may not appear to be that different. But when you're looking at the definitions of what constitutes flood insurance, as we have on the slide here, they are for the most part the same. One of the things that we did in the joint trade letter is we kind of went through side by side and talked about the proposed FHA rule and what was in the regulator rule, and walked through some of the language differences. And those are all publicly available, so they could be helpful to review as well. But you've got the same requirements that it's got to be issued by a licensed or admitted insurer. And then you can also have surplus line coverage. If we could get the next slide, please. So walking through what the components are of private flood insurance, it's got to be, just like the prudential regulators, at least as broad as the coverage under the NFIP, meaning that the definition of flood needs to be substantially the same. You've got to have coverage for building and personal property. You've got to have deductibles no higher than the specified maximums under the NFIP. You've got to have coverage for direct physical loss from flood. And you can't have any conditions or exclusions that are going to narrow the coverage that's in an NFIP policy. That's pretty comparable to what is in the regulator's private flood rule. If we could get the next slide, please. You've also got to have, same as the regulators, 45-day cancellation. You've got to provide information about availability of NFIP, mortgagee clause. For a lot of us, obviously, in the mortgage industry, we want to make sure the mortgagee clause is substantially the same as the NFIP. And then there's a 1-year statute of limitations following a claim denial. That is, for the most part, exactly what's in the prudential regulator rule. And then cancellation provisions as well. If we could get the next slide, please. So this is where the differences are, though. I mentioned earlier the four big components in the prudential regulator was mandatory acceptance, discretionary review, the compliance aid, and no mutual aid societies. Well, under the FHA rule, no mandatory acceptance. If you are originating FHA loans, you do not have to accept a private flood insurance as you do if you are a prudential regulator, if you are regulated by a prudential regulator. So there is some concern in the industry that could give some folks a commercial advantage one way or the other, depending on how you look at it. The second big difference is that the FHA has said no discretionary acceptance. So if you are going to be accepting a private flood policy, you have to go through the analysis of all of those components that we just talked about to make sure that this is a private policy that would be acceptable to the FHA. And in the comments or response to the comments in the Federal Register, the regulators went through why they didn't think that they could accept a discretionary analysis. And effectively what they said is, and I will read from it because I thought it was important, that FHA believes it's in the best interest of borrowers and HUD's fiduciary responsibility to the Mutual Mortgage Insurance Fund to not offer discretionary option and to require that all private flood insurance policies meet the definition of private flood. And so those factors are kind of a running theme through FHA's comments on why they rejected some of the things that industry proposed, which is primarily that their number one, or really their kind of twin goals, are to protect FHA borrowers and then also to protect the integrity of the insurance program that they fund. And so that is the same reason why they did not allow for mutual aid societies. They said that mutual aid societies are not subject to any sort of state regulation that can verify the liquidity of the societies. And so they didn't think that they were a good option for FHA borrowers or for the mortgage insurance program. And then the final difference is the compliance aid language. So the prudential regulators specifically reference the Biggert-Waters statute in their definition of what constitutes that the policy will satisfy that statutory definition of what constitutes private flood insurance. The FHA compliance aid is different, and specifically references the FHA rule for the acceptability of private flood insurance. And so Patrick's going to talk about the industry and how the insurance industry will respond to these differences. But effectively, what this means for regulated lenders who want to, or folks who are selling to Fannie or Freddie who are accepting private flood insurance and they want to do it on FHA loans, you are effectively going to need to have both compliance aid statements on your policy if you want to rely on the compliance aid instead of, especially for FHAs, going through all of those criteria and reviewing an entire policy to make sure that it's going to be acceptable to the FHA.
So Heather, on that, if I could stop you for a second, so that as I think about that, but the question why comes to mind. I'm like, why did they, in the case of the compliance aid statement? I know Patrick's going to go through a bit more in terms of impact and significance, but did they use the same justification to reject consistency here as they did in the other places, or why did they feel it was necessary to stay firm on two different compliance aid statements?
They really limit it to what they think they were statutorily authorized to do, that they're not regulated by the regulators that issue the private flood rules. They're not, and that because of that, they needed to make sure that they were in compliance with their statutes and regulations, and that they're limited in what they can do from a statutory standpoint.
Patrick, Sarah, on that particular question, any additional thoughts on their rationale there?
Well, yeah, they it was a surprise to me, but I do think that they are correct in their reading of the federal statute only with respect to they're not specifically called out in the provisions that mandate private flood insurance acceptance. The GSEs are, and federal agency lending institutions, federal agencies, but FHA is not specifically included in those sections of the statute that require the acceptance of private flood. So that's why early on they said we don't have to let lenders accept private flood because we aren't bound by that part of the statute. But I certainly think that I don't think there was I think it was probably an oversight for them to be left out of that requirement. I don't think it was intentional. There's no reason that they should have been left out. And I think it's certainly congressional intent to expand the private insurance market. So I'm disappointed. I think they could still have pointed to the federal statute and required its program lenders to abide by that federal statute, which many of them already have to do. I don't think they had to reference their particular regulation instead of the federal statute. And
we did, Scott, the comment letters respond and articulate the argument that Sarah just made, that, well, everybody else is included in it. There was no intention to exclude FHA from the mandatory purchase or for the mandatory acceptance of private, or the acceptance of private flood insurance in bigger waters, and that they should have been included, and under the spirit of the statute could have referenced 42 USC 4012, but they declined to accept our proffered interpretation.
Yeah, and then the statute they do reference is the rules on the issuance of the mortgage insurance by FHA. So it's their rules as a guarantor, and so it's outside of any flood insurance statute or language. So it's interesting that again, that's their basis, and they're seeing themselves only in that window with respect to the flood insurance compliance piece. And not drawing even so much as a dotted line to the flood reg. So yeah, interesting interpretation by FHA, but again, on paper, technically, from a just looking at the words, it's a justifiable position by them, but certainly one that I don't think was restricted. I think if they had wanted to expand that interpretation again and kind of dotted line to the flood statute, I think there's room to do that in the wording. But again, I'm not an attorney or a legislative drafting expert, but definitely interesting that their authorization or their focus here is as the guarantor and their obligations therein, as opposed to an agency that is supposed to be participative in the enforcement, encouragement, if you will, of mandatory purchase.
Yeah, one thing that as y'all were talking about it, that I want to come back to you on, Patrick and others in a bit, is this idea of risk, and what risk is HUD concerned about. That Heather, you talked about their justification for some of their positions, but I want to come back to that. But so if you go to the next slide, Patrick, staying with you. Can you walk us through some now what? Now what? What are the impacts? What are the implications? What's happening with the broader industries?
Yeah. So what do we do now? Be careful what you wish for. We wanted a rule. Now we have a rule. What do we do? I think the biggest, the lead bullet here, we're talking about what do we expect in terms of carrier adoption of the compliance aid language. So we'll stay with that for a minute. If we look at the adoption of the agency language as sort of a barometer for what we think will happen with FHA, we do expect adoption by the carriers, but I don't know that it carries the same weight in terms of an endorsement for compliance. Again, because of the basis for where FHA is coming from in how they drafted their rule versus the agencies. However, there's language in that FHA rule, and Heather pointed it out too. If you haven't read the scintillating commentary that goes with the first 62 pages of this rule, the commentary really gives a lot of background. And in there, the agency, the FHA, is very specific as to you can accept the compliance aid without further review. And that's in the final rule as well. And they do it, they give an explanation as to reliance on that compliance aid in and of itself as a standalone. And I think industry would be wise to take that statement and just run with it. The FHA is at least matching the agencies in terms of this statement is good enough. Now, if you talk to some of the carriers in the industry, or if you really dissect, as Heather was pointing out, some of the criteria that are in that FHA rule specific to, cancellation provisions and the policy not being as restrictive or at least as broad as. Another one that comes up is that criteria that the policy itself include a statement about availability of coverage under the NFIP. Well, no private carrier is going to include a statement about availability under the coverage under the availability of NFIP, in an ISO modeled sort of homeowner cloned form that's filed and approved at the state level. That's going to be an add-on. Is that going to be good enough? And so we don't know where the FHA we don't have history here from an enforcement standpoint that we can look at. Are those examiners really going to want a checklist style review like Heather talked about? The rule again says without further review. So I'm leaning on that. I think that if the language has the compliance aid statement and we expect carriers to add that, then that's good enough. Let's move on with that and let's go from there and then focus on that population, that small population of the private carriers that will not provide the compliance aid. And then I think that raises questions for lenders.
Hey, on that, so it sounds like you expect, or in your conversations with others, that there will be industry adoption. So we'll have this dual statement in a lot of cases. But if I'm not mistaken, I believe certain state legislatures had already passed into law some legislation that kind of acknowledged the language around the existing compliance aid statement of the federal regulators, the original language, I guess I'll say. And I think Delaware just added to that list. They passed a law last month. So is it foreseeable that industry may feel they need to go back to these state legislatures to get bills to modify these laws to contemplate both statements, or is that not necessary? Or any thoughts on that?
I don't know that it's necessary. I think you can go above and beyond. I think the state statutes in the South Carolina, Iowa, Delaware come to mind. They've really adopted the NCOIL sort of model act for accepting private flood policies or accepting flood policies from private carriers as intended to model or match NFIP policies. And so I think it's a floor. It's at a minimum. And so I think if you have two compliance aid statements now, that's okay. So I think those model acts are meant to serve as a minimum for entry or acceptance as being considered equivalent, and anything above and beyond is good as well. And so then, next bullet, the private flood policy, origination versus servicing scenarios. I mentioned that. Sarah touched on it a little in the opening as well in terms of the comments that we offered. There's a little bit of a difference between the obligations for acceptance at origination. You can infer that there's a higher hurdle for lenders. Delivery of an unacceptable policy that you have originated and closed and are delivering to FHA would certainly be would stand out more than if you have acquired the servicing on a loan that's in its fourth or fifth year and the policy was perfectly acceptable last year without well, not necessarily perfectly acceptable, but was accepted last year. So what do you do now? What do you do now if that compliance aid is missing? So I just call out the difference between origination and servicing scenarios. I highly suspect, again, based on some history with FHA enforcement, that the bulk of enforcement will be on new loan delivery and newly issued guarantees and delivery of loans. So I just throw that out as a bullet. I think that servicing scenario is going to require a little more deliberation within servicer shops as to what to do with this policy. Do you have a rule for hard rejection of all FHA policies without the compliance aid language, or what do you do there? And then again, the lack of discretionary acceptance. Heather talked about this. There's really only the two tests for a private policy. You either have the compliance aid policy or the policy terms are acceptable based on a review. So no mutual aid, no discretionary, some of the other differences with the agency rule. And so, again, as I started with the discernment of the compliance aid language, what do you do when that's not there? What level of review is required? Is it going to be a checklist? Is it going to be one for one? Is it really possible to get apples to apples with the NFIP policy in terms of the language and the terminology? And I just don't know that you can. I think there's a lot of examples in the industry, when you look at cancellation provisions, inclusion of certain statements, like I talked about earlier, the availability of coverage, can that be that's going to have to be some kind of overlay or cover letter or something from the agent, the provision for filing suit. And so that without that wiggle room that you have in the discretionary rule from the federal agencies, you don't have that wiggle room here. It's binary. It's yes or no. How strict do you have to be in acceptance or rejection of that policy? And so, are you faced with the scenario where you would be rejecting a policy for an FHA borrower that would otherwise be acceptable for an agency borrower? And what complications does that create for your institution? And so that's a question that I think a lot of financial lenders and servicers are going to have to answer. I don't have a great answer for that because, again, the FHA rule provides no provisions whatsoever for thinking about the institutional risk, if any, as well as any of the customer experience. And so you're really looking at, again, this sort of binary choice of FHA rule, yes, no, on, off, in, out type of analysis. There are industry resources that can help with that analysis. And I talked earlier about, comparing an NFIP policy to a private flood policy. Assurant has expertise there. Massive Cert, I know they're a member. They may be on today. Agents, there are plenty of talented agents, subject matter experts. There are plenty of people. I'm not trying to call out or do a commercial for some, certain firms or not firms. I'm just saying there's plenty of resource available in the industry that can compare the NFIP policy to a private policy. But again, how exacting must you be on that interpretation of that FHA criteria for what we know as insurance industry insiders know really is an unfair comparison. So again, policy language that's just not going to be apples to apples. And so is the intent good enough? Do you get into a subjective assessment? Well, this expert said the policy does mean the same thing or is intended to mean the same thing. So is that good enough? And again, FHA does not provide a lot of detail in their rule on how that review should occur or how it should be documented. And so we're left to come up with those answers ourselves as industry, and they're a little tough. Luckily, I think the incidence of those will be low in terms of numbers. By the time you filter down FHA loans and in a flood hazard area with private flood without the compliance aid language, you get to a rather narrow population of loans and borrowers. And it really becomes an issue of what's the right answer here. But again, I think you have to consider that a perfect application of the FHA criteria really is not practical in this instance. And so, what do you do now?
Yeah. I think this discretionary piece, I think it's important as well. And I think it's a good call out that member companies have responded to fill a need here. And I'll say Massive Cert now, Zactus, and Newmark and others, and Assurant, as you mentioned. So the industry has responded to fill that need. But this goes back to that risk question. And Heather, I'd like to bring Heather and Sarah back in here too. Heather, you talked about the HUD's explanation around the risk they're trying to protect consumers against, and also protect the insurance fund. And it seems like they spent a good amount of time talking about the deductibles and risk around deductible amounts. I'm not asking if we think they overdid it or something, but in your opinion, I guess going back to the NFA letter, the comment letter, the NFA said, we don't see any additional protection here by not being consistent in this way. We don't see how it's being protected. So do you, Heather or Sarah, others, Patrick, what are your thoughts on the risk that they're trying to protect against?
The thing that's funny to me is I was reading their explanation of why they wanted to protect. I get the wanting to protect the borrower. When I think about Florida and I think about carriers pulling out of Florida, I see. But when it comes to protecting the mortgage insurance fund that FHA operates, if a lender accepts a policy that FHA thinks is not sufficient, FHA is never going to be holding the bag at the end of the day. They're going to deny the claim. So it's really the lender. If the lender feels like, from a safety and soundness standpoint, the policy provides adequate protection for the loan, then that should be sufficient to the FHA. Because if FHA thinks it wasn't sufficient, then they can just reject the claim. They can deny the claim and say, well, we're not going to pay for your mortgage insurance claim on that one. You're going to be left holding the bag. So that one I don't see that it, even from a theoretical analysis, I don't see, because they don't have to pay the claim.
And it's not as though discretionary in the regulations, the federal flood regulations, it's not as though discretionary acceptance didn't have its own protections built in. Like it contemplated that you're protecting the borrower and the assets. So Sarah or Patrick, any other thoughts on this not allowing for discretionary?
Again, coming from based on where FHA is coming from, the basis for their decisioning that's explained in the commentary. Again, it's a defensible position for them to say we're solving for the fund, and here's what we based it on. Part of that was the OIG report, which especially members on this call would argue wasn't a perfect methodology for assessing flood risk that OIG came out. So they're probably working from a little bit of an overstated position of what their risk of uninsured loss really could be, and so that may be driving part of it as well. But I think it's just the pure interpretation by FHA in the reading of how they are or are not excluded and referenced in the flood statute and their own insurance, the mortgage insurance statute, and they just applied that language to this in developing this rule.
Mm-hmm. Yeah, and I the thing I worry about is without that discretion, the ability to accept a private policy that is not doesn't line up entirely. I think it really puts lenders in a precarious position. I can see if you don't have that FHA compliance aid language, I can see lenders saying, especially smaller folks, smaller shops, that we don't have the expertise to review a private flood policy. And we also know that we can't allow for some variation from an NFIP policy and accept that. So we're just not going to accept it because, as we mentioned at the earlier, the FHA rule doesn't require a lender to accept a private flood insurance policy. So I think that I won't be surprised to see if lenders are just categorically saying we're not going to deal with it. And that would be very unfortunate. And it's certainly counter to what, what the FHA's intention is, which is to expand consumer choice. And but I do think that because of the way they varied from the federal regulations, that it's a tricky situation for lenders, and it may not end up serving FHA borrowers as well as we hope it would.
Yeah, I think if we go to the last slide, there's a couple bullet points there that just hit what Sarah's talking about. That middle bullet is there a different process for handling FHA insured loans, and nobody's going to want to support two buckets of rule sets, right? Oh, I got agency rule and I've got the FHA rule, but we're almost headed that direction. And then there's the argument around the may accept versus must accept, and as we've talked about, and Sarah just pointed out, and so again there's a little bit of that dilemma in the FHA rule. Yes, it's exacting in this sort of binary. You have the compliance aid or you meet all the terms, but then it's also you may accept the policy. There's no must there as well. So interesting rule set to go through for lenders and servicers.
And just to remind the audience, so we have a few minutes here. You could submit questions via the chat function. And so do you think, Patrick, then that is it a question of what are the implications of choosing not to accept when it passes muster via the federal flood regulations, but yet they have these concerns on the FHA side?
I would probably punt that question over to Heather to assess the risk of civil litigation. But I think at that point, the question is, if I reject this policy and require lender placed or NFIP, something other than this private policy in order to be acceptable, that FHA borrower, you have to answer a lot of questions there as the servicer lender. And what's the authority in the security instrument? Is that going to be judged as a reasonable rejection, which is kind of that contractual language at that level? And then you kind of get into that disparity between, well, it's okay for Fannie and Freddie, so the guy next door can have the policy, but I can't. And so does that raise a civil litigation risk? Is there a underlying RESPA concern as well? So I'd probably point to Heather on that, but I think those are the next level questions that come up in that scenario.
In addition to the risks that Patrick indicated, I would also include a CRA risk if you are rejecting a private policy. And I know Sarah and I have talked about this, and she has examples of borrowers whose loans didn't close because and this is before the rule allowed for the acceptance of FHA policies. But if the small lenders that Sarah's talking about don't want to accept FHA policies and are just going to categorically reject them, or it's going to put somebody out of an FHA product, then you could have CRA considerations. There are always going to be fair lending risks if folks are not allowed to close the loan because the private policy was rejected. Depending on which private policies are accepted or which private policies are rejected, there may not be any discriminatory intent whatsoever, but the litigation and the discovery around that would be very expensive for a lender to justify or to defend what their decision-making process was. And I think kind of one of the biggest issues just from an operational standpoint is that because the regulator private rules came out in 2019 and folks put systems in place, and most of the regulated lenders are looking at things on a discretionary basis, they're not going through that full analysis. If you want to, you can't apply that system to FHA loans. And so that creates a big operational problem for people.
So I have one final crystal ball type question that I'll ask each of you. And before I do that, I do want to thank again the support team of Ali Bojas, Layla Taha, and Caitlin Tabone. Thank you all for supporting this. Before I ask the final question, panelists, did you have any additional thoughts you wanted to share that we didn't already cover?
I think we got them.
I don't think so.
So in wrapping this up, and again, thanks everybody for participating. But so as you look 6 months, 12 months down the road, any particular thought, and you could take this any way you want. Do you see that is industry going to go back to HUD and try to, again, we see this as a first step. Is there going to be a push for a second step? Do you see the market or the insurance industry responding very quickly and swiftly to make this work as best as possible for FHA lenders? Do you see litigation in the future? I mean, any particular predictions over the next year or so? Patrick, Heather, then Sarah.
Oh, I think the carriers will add the compliance aid language, but not as quickly and not as confidently as they did for the agency statement. I think it's going to require more deliberation at the carrier level to add the FHA language, because I think, again, there's that it's kind of a binary application of their rules, and is the carrier really comfortable saying yes under the FHA no discretionary letter for letter, apples to apples application of FHA language? I, as a carrier, will still say this policy, my private policy, meets the terms of the NFIP, or is equivalent enough. So I think that will require a little more discernment within the carriers providing these policies today. I think they will come on board, but it will take a little longer. It'll be a little slower. So I would make that prediction.
And just let me insert. I see Debbie Fleming. Thank you for the comment. I think if you see that comment, she acknowledges the challenge that lenders are in the spot here. It's not as easy in the lender arena. We're either cited by the federal regulator or the FHA. So Heather, Sarah, either if you want to respond to that or provide a prediction.
So Debbie hit on kind of where my prediction is, which is, as far as I know, and I would love it if people have examples, they can shoot them to me in an email. I'm not aware of anyone being dinged in an exam by their regulator for not accepting a private flood policy. Because I think the way that would have to happen, it under the mandatory acceptance, you would have to have a copy of a policy in your loan file that was not accepted. And that, I will say, that's what I was worried about in the beginning, is when we first started the private rule, that people were not going to be able, if people were rejecting a policy, they would have to establish why they rejected it under the regulatory framework. But I don't see FHA reviewing policies or reviewing what they receive. So at the inception of the loan, I think what's going to happen is, once there's an FHA claim filed on the loan, to Patrick's narrowing of you're going to have an FHA claim filed on a loan that was destroyed by a flood. And then maybe FHA will look at that policy and say, oh, well, this one doesn't meet all the criteria, so we're going to deny your claim, and you shouldn't have accepted this policy. But my prediction would be that we could tie ourselves in knots on the front end, but then at the end of the day, the chances of all of those things happening are probably pretty slim. But okay. Debbie says can come across as a customer complaint. Very true. You could definitely have, especially borrowers who are unable to close a loan because they couldn't get a private policy. That is a good point, Debbie, to see where that could pop up. But I at this point, I'm usually one to say, oh, there are all sorts of potential problems out there. But at this point, I'm just not really seeing a big risk on FHA saying you should not have accepted this policy. It doesn't meet our criteria. I could be wrong on that. I'm going out on a limb there, but
Yeah, I think the tricky part is, again, it does feel like lenders are in the same position in a way that they were before. If we don't have that insurance FHA specific compliance aid language, let's hope that the FHA review, at the time of claim, can maybe look more closely at policies. But I think that FHA seems very, very wed on this position. I don't think, even though there is a 30-day comment period, I really don't think they are going to budge from where they are right now. What I think will happen, maybe it's not going to be this this coming year, but at some point there will be enough borrower pushback, enough consumer groups saying, this is not right. This is, especially because it's FHA borrowers that are low to moderate income, that are typically the underserved communities and communities of color. And you make it so difficult to, figure out whether or not a policy is going to be acceptable under the FHA program. That's when I think something might change with FHA, but I don't think it's going to change before there's exterior pushback.
Yeah.
External.
Thank you. Well, we are at time. Thank you all so much. Thanks for the attention and participation and attendance. Thanks very much to the three panelists you see here. Wonderful and great insight and information. So thanks for joining. If you have ideas members, if you have ideas on future webinars for 2023, please reach out to the board and we will consider those. So thank you all very much for your time, and have a happy holidays and be safe and warm. Thank you.
Thanks.
Thanks.